Okay, good morning. Welcome everybody to day two of Round the Clock Trader. A few minutes behind our scheduled start time, so apologies for that. But thank you for all being here prompt on time as well. Great to see you all here. I can see Steve and Mike and Jung and Boris and Ash. Yohai's here, of course. Ravi Chandran, welcome. Good morning again to you all. Let's have a great day. It's going to be more fun thrills and spills. We're starting with Forex, no particularly the inflation to recession talk by Yohai Ilan is going to be quite revealing. Thoughts for 2023, major pairs, what we can expect maybe from the dollar is coming up. Now, we are unfortunately still having a slight issue with sound, which means that you can hear me. Well, hopefully you can hear me. In fact, I should just ask you if you can hear me. First of all, just let me know in that chat box. I've been able to hear Yohai and see the slides, but he can't hear me, unfortunately. So we're going to hand over to Yohai now, and just let me know if you can hear Yohai in addition to me. Here we go. Okay, thanks very much.
Okay, I got the thumbs up from Simon, so we can kick it off. Sorry for the short delay. I had some technical stuff. I'm glad that you can hear. I'll also leave time for questions, of course. Well, glad to see it's working. So we're going to talk about the shift in focus in markets from inflation to recession. My name is Yochai Alam. Yeah, it's a new year, January 2023. So I used to be a retail trader. I used to be a computer programmer. I founded my own website, Forex Crunch, back in 2008. I've been an analyst for FX REIT since 2018, focused on fundamental analysis. I'm leading FX REIT's premium product. If you want to sign up, then you're welcome to check out the site. But that's enough for the introduction. Let's kick it off. Let's begin talking about the main thing. I focus on Forex, but it affects other markets. We're going to mention stocks, of course. And yeah, this is what we're going to talk about. First, the diet against inflation. It's working. We'll show a bit of that. We'll show some of the successful sides of that, but also move on to the negative part where the cracks are beginning to show. I'll argue why policymakers need to act because the world is moving faster. And then perhaps the most interesting part or actionable part, especially for you that are, well, trading foreign exchange, I'll try to provide my bets, my currency directions, and we'll leave time for questions and answers. So the diet is working. And it was quite a diet. So we've gotten used to interest rates being extremely low at the zero end, cheap money. I think it came to extreme in 2021. That's well, mortgage rates were extremely low. Startups got funding very easily. Crypto was booming. Everything happened, but eventually, all this money from stimulus, from also caused, well, there were other issues, but it caused inflation to rise. And central banks finally got their act together last year, which ended just now. So we got interest rates in the United States of America, the world's largest economy, rising from 0 to 4.5%. It was epic. It's the fastest rise since the 1980s. And even in the Eurozone where I'm based, I'm here in Barcelona, we had zero interest rates for a long time. And we had a deposit rate. I mean, commercial banks had to pay the European Central Bank just to keep their money there. But anyway, the main lending rate was zero and it jumped to 2.5%. In the UK, went from 0.10 to 3.5, and also other economies, Canada, Australia, and even Switzerland, also with negative rates. Well, they're a bit inflation averse and they had to raise rates. So we had all central banks raising rates at the same time, and this is a visualization of that. We're back to the 1980s. Well, not in everything, not in music, but in terms of interest rate rises. So this is how it looks, flat, 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 then everything. The only way is up, to mention an 80s song. So apart, in addition to raising interest rates to fight inflation, Some central banks also began withdrawing money from markets. So if we go back to 2008, the great financial crisis, uh, central banks cut rates to zero and began printing money to buy long-term bonds in order to lower um, lending conditions, to improve lending conditions for the long term, to provide certainty. Printing money, it worked extremely well, until it was a bit too much, and Federal Reserve began withdrawing money from markets, just letting its maturing bonds mature, refraining from reinvestments. The UK went a step further, actively selling bonds. And the European Central Bank announced it would begin doing so in March. Everything is always a bit late here in Europe. But in any case, we're talking about money coming out of the markets by central banks. So the opposite of quantitative easing, we have quantitative tightening. It sounds better in its abbreviation, QT. In any case, this is how it looks on the chart. The Federal Reserve's balance sheet. The US printed a lot of money and around the COVID crisis. It continued gradually. The balance sheet continued rising, and then it began coming down. And that's what you see. You see the effects of that. You see the effects of in housing. It's becoming a bit cold. No more supply chain issues. It also helps inflation come down. Okay, so it wasn't only inflation caused by stimulus checks in the United States or central bank printing. It was also these rapid shifts around the pandemic from consuming before the pandemic more services and well, everything was stable, services and goods, to focusing on buying goods such as cookware for my kitchen, but now people are back to restaurants, so it's back to services. So it caused all these vast changes and big disruptions. Oil has come down due to multiple factors. Well, the war is going on, but countries have adapted. The US released oil from strategic petroleum reserves, SPRs, and China's COVID restrictions, which we'll touch later on as well, they limited demand. So all in all, we're having a victory in the war against inflation. And the fall in the price of oil also has an impact on other prices. So this is even, well, US headline inflation dropped from over 9% to 6.5%, but also core inflation, the part that excludes energy, excludes food, it has also been coming down. So that's good news. Yeah, this chart perhaps isn't fully reflected, but it's coming down. So just in a few hours, we'll have figures from the United States about growth. But so far, most things look good. I'll mention a few of them. We're expecting US growth around 3% annualized in the last quarter. Germany seems to be avoiding a recession. They're the most dependent economy here in Europe on cheap Russian gas, which is not cheap anymore. And they're avoiding a recession. Here in Spain, the growth is even faster. UK is holding up all those gloomy forecasts. Well, gloom remains, but things are not as bad, despite the big political crisis we had in the UK back in October. And the housing issues, this bubble or burst of the bubble, so far it's limited to Sweden, small country, New Zealand, another one, and Canada, a bit bigger, but it doesn't affect. We're seeing more of a soft landing in the US, in the UK, and also in Europe. So far so good. And also the labor market. I mean, in the UK, we're seeing ongoing labor shortages in the NHS, elsewhere in the United States, world's largest economy. We're back to what we had in 2019, or which is equivalent to what we had in 1969. So that's even before the 80s. We got 3.5% unemployment. So if you focus on these headline figures, everything is going well. If everything's going well, the central banks can continue raising interest rates, especially the Federal Reserve, which has been warning us about premature easing in the European central banks. Finally, the Germans, the boys who cried wolf for years about the dangers of quantitative easing, dangers of printing money, finally they're vindicated. Finally, the wolf is here. And and now they have more control and they want to continue raising rates. I would say only UK policymakers are a bit more gloomy, but in general, the main idea here is that central banks need to continue raising rates and keeping it at high levels before cutting rates, because it could be a bit more um, because things could get worse, or the mentality, inflation expectations need to cool down before before we get back to normal. I think the world is moving much faster nowadays, and that the cracks are showing. So we're seeing in the United States tech layoffs. So nobody is going to shed many tears about a computer programmer who earns lots of money, was hired for an extremely high salary when companies had a talent war, and was fired from one of the major companies. This programmer will easily find a new job. But the tech layoffs have a growing effect. First of all, it's spreading to more companies, more big companies, and also coming to smaller companies, and also affecting other businesses. We're talking about hundreds of thousands of layoffs. In the US, the Christmas season was not very happy. Yes, Christmas might seem a long time ago. We're already towards the end of January, but retail sales were not that strong, not that many gifts, and even wages cooled down in December, according to the latest jobs report. So, in general, things are good, but we're beginning to see the cracks showing, the too much success in the fight against inflation. Here's another chart which shows that we're already off the highs. We're beginning to see a cool down in demand in open jobs. Okay, so moving from the US to Europe, the world's well, second or third largest economy if you look at the Eurozone as a whole. So far, so good. We've been very lucky. I mean, now it's a bit cold outside, but in general, this has been a very mild winter. And why do I mention the weather when I talk about forecasts for currencies, not for the sun? Because extremely high energy costs were a big pain for consumers and for businesses, especially in Germany, but also in other places. And this warm weather and the restart of previously maintained, well, nuclear power stations in France that were undergoing maintenance. Everything sort of is helping the old continent, Europe, come together. There are lots of political unity, even now with Ukraine. I mean, finally we got a deal about sending tanks. But there is success also there, thanks to luck, to the weather, and to adaptations, which is not only luck, but there is something to worry about. Lots of this growth or lack of a recession in Europe so far is fueled by governments, and there's not much fuel in the tank, as New Zealand's now outgoing Prime Minister Jacinda Ardern said. So, with the pandemic, governments rushed to help the economy, to help workers, and we got government spending as a share of GDP jumping in 2020. In 2021, it dropped a bit. 2022, it's still very high, and these are figures that do not include the last quarter. So it'll be much harder for Europe to continue financing that kind of growth, especially as borrowing costs are rising. Okay, moving to the world's second largest economy when we talk about a country, or, well, alongside Europe, let's say the second, China. The population is shrinking, and that's something very, very long term, but it made big headlines, and I think it also has an impact on the country's consumption. So China went from back in November talking about how horrible COVID is, how horrible long COVID is as an epidemic in the United States, to, well, it's just like the flu. I mean, the shift was extremely fast, but you cannot really click the undo button, the Control C on your keyboard, and get things back to normal, to pre-pandemic growth. People are still afraid of the impact of the pandemic, and so consumption is not going to rise that fast. Another thing that Chinese government did in recent years was cracking down on indebted property developers such as Evergrande. You've heard of that. probably heard of that. And now they're easing the restrictions on the housing sector. Once again, it thinks you cannot click the undo button. People should still have memories. And the same goes for the tech sector. So the Chinese government cracked down on several tech tycoons, which are making lots of money, but were also boosting the Chinese economy. And now it will allow, for instance, the Ant Group to do an IPO, easing stuff, trying to stimulate the economy. But it won't be so easy. Trust is very important, or the number one thing in economics, and trust has been broken, or we're seeing cracks over there. So I believe China will help the global economy in 2023. The big Chinese reopening will be positive for growth, but not as much as in 2009. So if we go back to the pandemic, if we go back to the great financial crisis, we had that G20 meeting at the beginning of 2009, everybody promising to stimulate the world. The US did its share, China did much more. This time, China is trying to help itself, of course. I don't think it'll be a savior of global growth like it was last time. Okay, so for me, the message to central bankers is that it's time to wake up. I don't know how many of you here are in central banks, but hopefully my message will come through. But for us here, busy in markets, trying to make a profit, trying to be aware of what's going on, these are the things that, in my opinion, you should all be looking out for. So in 2022, we had the major market mover being US inflation reports, the CPI, Consumer Price Index. These became more important than jobs reports. I think this will change. We have, between the upcoming Federal Reserve decision next week and the next one in March, we have something like 6 weeks. And in between, we have 2 jobs reports and 2 inflation reports. And I think this will mark the shift in importance from inflation, which is coming down, the battle has been won, to jobs. And these are really critical reports for the global economy. The United States tends to lead the global economy, and the others follow. And I think we're going to see a shift from fighting inflation to worries about a recession. Here in Europe, eventually higher borrowing costs will have their costs. Governments will not be able to subsidize energy and help consumers forever. Everything here again is slower in Europe, which has also has its advantages. I can't complain, but I think eventually there will be some discontent about rising inflation. Rising unemployment, which is currently not the case, but things will gradually move towards that direction. And where some of the impact of China's reopening is higher demand, higher growth, and perhaps higher inflation. I don't think we'll see that kind of inflation. I think we'll see some reinvigoration of the Chinese economy, some boost, but not enough to push inflation higher. And once we see that inflation is not really coming up in China, then again the focus will be more on growth, on employment. Okay, so here we're talking about forward-looking. So we're talking about surveys. This is the ISM Services PMI in the United States. Services something like 70% of the US economy. According to the latest survey for December, we'll get a new one next week or following one. The services sector is already squeezing, it's in contraction. Now, this is a survey, it's a forward-looking sentiment piece of data. It's not evidence, it's not hard data, but these figures tend to be relatively accurate. So I think this is a warning sign. So what's next? We're going to have a rate decision by the Federal Reserve, the world's most important central bank, and this is Jerome Powell, the most important central banker. They're gonna raise rates by 25 basis points. Why am I so confident? Because that's what markets are pricing in. The Federal Reserve, contrary to several other central banks, does not like to surprise markets. They had the chance to fight market pricing in speeches before they began their blackout period. They didn't do it. That means an endorsement of what markets expect. So I expect the Federal Reserve to raise rates with 25 basis points next week, and also to say the battle against inflation is still not over. It's premature to declare victory, and to repeat all these things to indicate that there will be more rate hikes, and more importantly, as they always stress, that they will leave rates um, at high levels for a long time. No cuts in 2023. But the year has only begun, and well, we'll talk about their potential U-turn later on. But for now, the data is strong enough evidence of a soft landing, and the cracks are a bit more in the background. So I do not expect the Fed to signal any kind of a U-turn, but to wait for more data, wait for new forecasts. These are the Federal Reserve's forecasts back in December. They showed that interest rates are set to rise to something like, well, a range of 5.13, 5.37, well, 5.25, let's put it that way, which is 3 more hikes, and leave them that way for until the end of the year. That was in December. In February, the Federal Reserve does not publish new forecasts. Markets are not buying these forecasts. They foresee rate cuts later this year. Very skeptical. So I think that moving forward, yeah, I mean, I expect go back to this slide. So the February's rate decision and the hawkish stance from the Federal Reserve will likely push the dollar once more to the upside. We had a similar move in December before the dollar resumed its falls, and I expect that kind of an upswing to come next week. But after that, I expect weak data to come along, for inflation to remain low, and for non-farm payrolls reports and that means employment jobs reports to become weak, to hurt the US dollars. And now the Federal Reserve is in a blackout period. They do not talk before the rate decision, but then after they announce the decision during the entire month of February, they can speak up and they can respond to incoming data. So I believe they will begin sunsetting the idea of ongoing tightening nonstop. And yeah, and in March, things can be different. They can talk about maybe they'll raise rates once more because they want to wait for the data or something like that. But that's when they will mark a pause. They'll say, okay, we're stopping for now. We're still going to keep rates high, but markets always think one step forward, sometimes 12 steps forward, sometimes always get ahead of themselves, and they will begin smelling rate cuts. Okay, so I expect after this high water mark in February for the dollar to begin falling. So yeah, this is perhaps part where I'll talk about well, the most actionable part for my focus is on currencies, but we'll talk also about stocks. So let's talk about the US dollar, the world's reserve currency. Not sure how many of you are familiar with the dollar smile theory. Well, the dollar rises when things are extreme. So it's a sort of a smiley smile pattern. Things are extremely good in the United States. The economy is hot, inflation is rising. So the Federal Reserve needs to raise interest rates. That means the dollar gets stronger. On the other extreme, the dollar has a unique position as a reserve currency, and when things are really going bad in the world, money flows to the US dollar, to the United States as a safe haven. Okay, so the dollar only falls, it's only in that bottom of the smile, okay, in the middle of the mouth, not in the extremes, when things are okay, when the US economy is growing slowly and then the rest of the world is also growing, and money flows from the US to other places to take bigger risks, to find better opportunities for higher yields. So I think the dollar will begin falling in mid-February when we get a few more data points. Data needs to be soft but not too horrible to maintain that bottom of the curve of the smile. Um, what would I consider horrible? I would look at the jobless rate, and if it rises, the unemployment rate rises to 5% currently at 3.5. I don't see that happening in February. That's already a warning sign. Okay, maybe here in Spain, unemployment is something like 12%, but each country has its own range of numbers. Uh, in any case, an increase from 3.5 to 5% would be very, very worrying, and that would already strengthen the dollar as a safe haven. But assuming in February we get small rises in the unemployment rate, instead of job gains worth over 200,000, like in recent months, we get something under 100,000, or even job losses, which cannot be ruled out, especially maybe not in the upcoming report for February, but the one coming in March for February. I think we could begin seeing soft data weighing on the dollar and growing expectations for the Federal Reserve to begin cutting rates later this year. Let's move to the euro. So far, so good for the euro. I think it'll continue rising. European Central Bank hawks are in control, Germans and also others. So they'll continue raising rates, continue being confident. When energy prices fall, then people have more money for other things. Wages are still rising. There's lots of collective bargaining here. But at some point, I think in the summer, we're gonna see the war taking its toll. We're gonna see enormous government spending taking its toll, and the euro beginning to lose its strength. So I think governments will face reality checks, political pressure, and the euro sometime in the summer will begin losing strength. So far, again, so good. I expect further strength in the short term. In the UK, the Bank of England is ahead of the curve, perhaps too much ahead of the curve. So too much gloom in the UK. This is Andrew Bailey, the governor of the Bank of England. So far, well, the forecasts are a bit too gloomy. I expect relatively lower rates or a sort of moderate pace of tightening to help the economy and eventually to strengthen the pound. Politics, contrary to what we had last year, look much more stable. So if we look at both the prime minister and the leader of the opposition, which according to polls is government in waiting, we're talking about centrist politicians who, well, impact also investment trends. So things look much more stable. A critical thing for the British pound is lingering Brexit issues. We have that Northern Ireland protocol. Seems like things are moving in the right direction in terms of reaching an agreement. Both the EU and the UK are talking about compromises. April is marked as a date for reaching a deal. That will be 25 years for the Good Friday Agreement. So things look a bit gloomy in the UK at the moment. They think they'll improve later on, maybe a bit quietly. Japan, here is Haruhiko Kuroda, the governor of the Bank of Japan. The Bank of Japan's policy is unsustainable. They still have a negative interest rates. They're the only central bank in the developed world with a negative interest rate, and they're still printing yen to buy bonds to keep the yield curve, the 10-year yields at 0.5%. But eventually they're just buying the entire bond market. So I think it's unsustainable. In addition, inflation is finally hitting the shores of Japan. Bank of Japan will eventually have to raise rates. Yeah, Kuroda ends his term in April, and maybe we'll see the big changes in May. Another thing that happens in the spring is collective bargaining, wage negotiations. The government encourages employees to get big salary gains. So if we do get them, I think it'll be the final push for the Bank of Japan to exit its extremely loose monetary policy, and that will be yen positive. Moving to Australia, well, Australia, everything looks good for now. China is reopening. We have higher Australian inflation, which is not that great, but it means a strong economy. We'll have a few more months of optimism, in my opinion, before we get some kind of China could be found out. We'll get weaker Chinese growth, and I mean, not as hot as expected, and we'll see the Aussie losing some steam. Housing market in Australia is also coming down from the highs. It's not as bad as New Zealand, Sweden, or Canada, but I think we'll see some kind of a cool down later on. And one phenomenon we're seeing, maybe the opportunity to talk about stocks. We're seeing big correlation between Australian dollar and US stocks. Global stocks are led by the US, and we've been seeing quite a significant correlation. I believe this correlation will weaken. I think we'll see the Australian dollar at some point losing some steam, but US stocks continuing higher on expectations for some kind of loosening from the Fed. So if we mentioned stocks, I expect the next week's rate decision to be relatively hawkish by the Federal Reserve, hawkish by the European Central Bank, and well, mixed in by the Bank of England. And the mood will be more or less, okay, central banks are still fighting inflation head on. They're doing too much, bad news, and stocks will probably suffer. But gradually, I expect stock markets to move higher, to recover, and have a sort of continuous recovery. If I mentioned 2009, I don't think it will be such a boom, but I think stocks will gradually move higher. Lots of pain has been seen in tech stocks. A lot of it is just the froth coming out, but these companies still make significant amounts of money. Technology is used more and more and more. So, and these are the leading companies. So I expect stocks to have a good year in general, but we'll see occasional corrections, and one of them I think will come next week with a relatively hawkish Fed decision. Let's continue to the Canadian dollar, Canada. So I wrote here that the Bank of Canada will follow the Fed. Well, there is they trade in tandem, but Canada occasionally is ahead of the curve. So just yesterday, the BOC announced another last rate hike, 25 basis points, but made it clear that it's done for now. It's taking a pause. So Canadian dollar weakened, and this move by the Bank of Canada opens the door also. Maybe Canada is leading and the Fed will follow. I also expect the Canadian dollar to struggle, not only because the central bank could eventually cut interest rates, but that oil, which is currently enjoying demand on these hopes of China's reopening, that these moves from Beijing will not be strong enough, and that oil will eventually lose some of its steam, and that could hurt the Canadian dollar. And interest rates have a long way to fall in Canada. So yeah, the higher you go, the lower you can fall. And yeah, the critical thing is the housing pain. Canada prices jumped in Toronto, Vancouver, everywhere, and now they're coming down quickly. I think the faster they fall, the better for the Canadian economy. The quicker the capitulation, the better to begin the growing once again. The faster it falls, I think it's better for recovery, but let's see how things move. So let's here are my bets to sum it up in a more organized way. So I expect until April the euro to lead, the Australian dollar to follow, enjoying hopes of Chinese growth. The yen, around April more or less, we're going to see perhaps not an announcement of a change by the Bank of Japan, but at least a hint, and that or strong wage negotiations. So we're going to see the yen also being relatively strong, the pound sort of in the middle, the Canadian dollar lagging on expectations for rate cuts, and the US dollar as well to be the last one in the pile. But all these expectations of things later cooling down in Europe and China, then I expect from April to late summer for the yen to be on the top on eventual tightening, some kind of tightening by Japan, the pound to creep its way up because things aren't as bad as people thought they would be. Not that things are that great in the UK. The euro to lose some steam, but still to be, well, number 3 on my list. And then the Aussie, followed by the US dollar, which I expect to remain low, and just to switch places with the Canadian dollar, at the bottom. And for stocks, I expect things to be a bit more stable, more of a return to the buy the dip mentality of general uptrend in stocks, not as nice as 2009, not as crazy as 2021, and but not the gloom that some commercial banks are forecasting. Okay, yeah. So we've come to the Q&A session. During my talk, I saw quite a few questions coming up. You get that screen closer to me and see what questions. I'll put it here. See what questions we have coming up. Okay, so we have a question from Rich. Yeah, we're all aware of this. Otherwise, you wouldn't be traders. Some things getting better. 2% inflation, though. 2% inflation. Don't think we'll get to 2%. We'll get to 3%, and it'll be good enough because we'll have expectations of inflation falling to 2%, and that would be enough for central banks to cut interest rates because I expect unemployment to rise and growth to fall. So, yeah, 3% should be good enough. In general, in academic circles, there is talk about raising the inflation target for central banks. 2% became the holy grail because, well, it's a very long story. 0% could trigger deflation and recession. 4% is somewhat too high. So 2% is a compromise from academics from the 80s. The world has changed since then. Demography, I mean, population growth is not that strong, not that much technological innovation like there was beforehand. So I think they can settle also for 3% and still see maybe perhaps getting to 2% this year would cause too much of pain in terms of growth and employment. A question here: USA housing is not great in some places. Big drops. LA, parts of Florida. Yeah, US housing is coming down, but just it's not the. And comparing it to Canada, New Zealand, and Sweden, where it's a clear bubble burst. So prices jumped, if I'm not mistaken, something like 50% around in response to the pandemic in Canada, and that's a big jump in a short period of time. In the US, it has been robust, around 20% year over year at some points, but there is room to come down, but not something that would have a systemic terrible effect on the economy. We're always gloomy in the UK. What makes us Brits? Yeah, there's a website, an Instagram account called Very British Problems. I follow it. Lots of funny stuff over there. Yeah, luckily, well, the good side is the good sense of humor. So interesting to note, UK is scrapping COVID booster campaign. Yeah, well, I hardly talked about COVID, only in the context of China. COVID booster campaign. Yeah, I'm not really aware of what's going on with that, but in general, well, health systems are still under strain, not as bad as the worst days of the pandemic, but I guess maybe that's a move to save a bit of money. Anyway, interesting to note, so next, most people I speak to are not having more COVID booster. Okay. Jobs was enough. Yeah. What's important in your view in the Fed? CPI, PC, or HPI, or the core equivalents? Core. First of all, core is more important than anything in the United States. That's what the Fed focuses on. So every change of every deviation of 0.1% between what economists expect in core CPI month over month and the actual outcome makes a huge difference to markets. That's what has been happening in the past year or so. I expect that to cool down. I mean, the focus not to move to another inflation figure, but to move out of inflation and to employment and growth. CPI still is the most important one because it's just released earlier. It's not that accurate. CPI is updated only every 2 years in terms of the basket of goods and services that it counts, and the PCE is more accurate. That's why the Fed prefers it, because it's updated, I think, every 6 months to reflect changes in consumption. So let's say I eat a lot of vegetables, and the prices of tomatoes have jumped a lot, and now I buy fewer tomatoes and I buy cucumbers, which are cheap. So the PCE would reflect that, and the CPI will not. So that's why PCE is always, well, it adapts faster to people's adaptations to situations, but it's released at the end of the month. So it's still a market mover, but not important. Again, core is more important than anything else. I'm expecting positive US GDP. Yeah, me too. If we're talking about, well, the data is coming out in just over 3 hours. So yeah, official expectations are 2.7%. Last time was 3.2. I also tend to expect a stronger outcome now because the Atlanta Fed, they publish what they call it GDP Now. It came out at 3.5%, and these figures have been relatively accurate lately. And so I also expect somewhat better than expected. And for the impact to be short-lived, we might get a jump in jobless claims as well, because the figures were distorted, sorry, in previous weeks because of various storms. So that's touch on the very, very short term. Some people are talking about Bitcoin again. Any thoughts on crypto? I'm not a big fan of crypto. Yeah, I know Bitcoin has a finite amount of Bitcoin. It's a limited quantity. That means it's not inflationary. But for me, it's a limited quantity of something worthless. Maybe I'm being too harsh. Hopefully not. Too many of you are huge crypto enthusiasts and will not get offended. But in general, yeah, Bitcoin, I think it replaced speculation on Bitcoin replaced gold, and now the focus is shifting back to gold. Yeah, we're seeing Bitcoin rising with the entire stock market and falling as well. Yeah, I don't think it'll go very far from here. Sure, moves are big. I noticed that there is one day a 50% off FX Street Premium. Today only. What's included? Yeah, well, the short pitch. We have various services there. We have really great, nice community, and our users don't only talk between themselves. They get to ask us direct questions to tap into the analyst's knowledge. We also provide trade plans. We have webinars from experts and a few other things. So you can try it out, take advantage of these discounts. And yeah, so if you mention the discount, I've just taken a ride on that and did my small pitch. US GDP, I think I answered that. Will the Japanese bond market crash due to yen printing? No, nothing crashes that fast in Japan. But I think that money will come out of Japan to invest in other bonds such as US Treasuries, and that could the difference in yields. Japanese yields would rise, and US yields would fall, and that would be unfavorable for dollar yen. I think dollar yen has more room to fall. Another question here. I think it's going to, well, a comment. I think it's going to be another good year in the FX market. I certainly agree. What makes the Forex market great? Volatility. What makes volatility? Changes in interest rates, uncertainty about interest rates, differences in interest rates. After many years that everybody was at zero, that there was lots of money going around, we had action in stocks, we had action in cryptos, we had gold. Everything was on the move, but Forex was very, very boring. These changes in interest rates, this uncertainty has caused lots of volatility recently, and I think it'll move forward. So yeah, I'm optimistic about 2023. Optimistic in general about the economy. So I don't think interest rates will fall back to zero, but they'll begin coming down this year. Not in Japan maybe, but Bank of Canada signaled a pause, and I think we'll see cuts. Will the yen crash? It's the same. Will the yen crash? No, I think it. Well, so far it crashed last year. It went. I mean, dollar yen went all the way to 152 from, if I'm not mistaken, 115. So 115 to 152. And that was the crash. Now we're seeing the recovery. Now we're at around 130. So I expected dollar yen to go down, which means a stronger yen. Yeah, we could easily fall back to 115. So I expect the yen to strengthen in 2023. Yeah, a few more. You have. I don't know if we have more time for more questions. Well, let's get that one. What currency will outperform the dollar most from the middle of February to April? Yeah, let me go back to my slide. Of course, these are not trade recommendations. These are my estimates. So I expect the euro to be the winner in the next few months. Euro to be the strongest, the dollar to be the weakest, and then things to change with Canadian dollar against the Japanese yen to be a big loser or the biggest mover. Okay, these are of course my projections based on everything, on my experience and knowledge, not trade recommendations. Yeah. Let's see.
Does anybody have any final questions for Yohai at the moment? Can you hear me, Yohai?
Yes, I can.
That's great. Thank you so much for that presentation. I think we've got around it all. I think we've covered it all. I mean, on balance, it's not the end of the world, is it? That we thought we might be looking at. There's things to be aware of, but there's some green shoots of optimism and things coming, which is quite good to hear. So it'll be interesting to see how that plays out. Is this what everybody that's in the room now? Is this echoing your own thoughts, or do you have any? Does anybody sort of strongly disagree with anything that Yohai's said? Just be interesting to see if there's another point of view or another opinion in the room. But thank you, Yohai, for that. Yeah, I just noticed on LinkedIn today that there's a special offer at FXG. I know you do all the premium and stuff. It's fantastic. It just said it's 1 day only, so coincidentally, it's the day that you're appearing on our webinar. So I thought it's good, a good time to make people aware.
I'll share the link.
Yeah, great. Because
that's not the link. Sorry. Anyway.
What's the annual?
Here's the link. Our marketing team will not like my pitch. They should have been better prepared. But anyway, yeah. I hope you enjoyed the commentary.
You're not about the sales. We get that. You're the senior financial editor. But you also do a great job. I mean, this is what we don't want to be sold. But I think it's important that people know if there's an offer like this to get in on the inside, the premium of FXG, because I know you guys, you've been around for years and do a great community there with the site. So
thank you very much.
A lot of speakers that we also know as well. Rich says, I say long-term USA should be strong. There we are. Good. Sharon, US dollar benefit on yield plus being the global business currency. Yes, it is still the main one, isn't it? So
indeed,
great news. Yen will be the laggard Great. Fantastic. Yohai Elam
Okay.
from fxstreet.com. There's the link there. He's posted to the premium offer. That's just today, if I'm to believe. I just noticed this on LinkedIn this morning, so I believe it's a good opportunity. If you've been looking at FX Street and looking at all the content they provide, you want to get in the inside. This is a chance to get 6 months for free, effectively. So there's the link. Thank you very much, Yohai. I'll take the reins back now because we're moving on to our next speaker in 5 minutes, Cameron Malik at Magnetic Trading. So many thanks again. Hopefully we can hear from you
Thanks very
soon.
much.
Take care. Stay well.
Thank you. Bye bye.
Okay, guys, thank you for that. We're going to move on into our session, well, session number 11. It's session 2 of today. I will be back in about 4 minutes' time with Cameron Malik for our seasonal trading strategy, trading the DAX, which is a very good presentation. So look forward to that. Time to put the kettle on, maybe make a quick coffee, and we'll see you back here at 10. Many thanks.